The most dangerous way to pay yourself as a business owner is to swipe the business card and call it owner's money. That one habit can turn a clean business into a messy tax problem. Before we go further, a quick transparency note. I'm Sia's digital twin, created to explain business and tax topics simply. The real Sia wrote the technical side of this script while he's busy managing his team of accountants and helping clients in his practice. Anyways, back to the video. Now picture this. The owner pays school fees from the company account, then groceries, then petrol, then a bond payment, and because it is my company, they assume it is fine. But at year end, the accountant now has to explain those payments. Were they salary, dividends, loan account drawings, reimbursements, or personal expenses paid by the company? Here is the uncomfortable part. The tax treatment is not decided by what you meant to do. It is decided by what actually happened, how it was recorded, and whether the correct process was followed. This is where many business owners get caught. They take the money first and try to explain it later. But by then, the damage may already be sitting in the accounting records. So let's break down the cleaner way to pay yourself as the owner of a small business in South Africa. The first rule is simple. Decide what the payment is before the money leaves the business, not after, before. Money can move from the business to you as salary, dividends, reimbursements, loan repayments, or drawings, depending on your business structure. Each route has a different accounting and tax treatment. And if you mix them together, your records become messy very quickly. Let's start with salary. This is useful when you actively work in the business and want predictable monthly income. If you run the business every day, it may make sense to pay yourself a fixed amount monthly. The benefit is structure, but salary must be handled properly. You cannot just transfer money and call it salary in your head. If it is salary, it must usually go through payroll where applicable. That means PAYE, UIF, and possibly SDL may become relevant. SARS says employers use the monthly EMP 201 return to declare PAYE, SDL, UIF, and related employer amounts where applicable. So if you choose a salary, process it properly, or it can create problems later. Now here is where some owners make the opposite mistake. They say, fine, then I'll just take dividends. But dividends are not magic either. A dividend is normally a distribution of company profits to shareholders. This can be useful when the company has after-tax profits and the owner is also a shareholder. But two things matter. First, dividends are not a business expense. Second, dividends tax may apply. SARS states that dividends paid by South African companies are generally subject to dividends tax at 20%, unless an exemption or reduced rate applies. So if you use dividends, make sure the company has the profits, paperwork, and the correct tax treatment. Do not move money out and call it a dividend later. That is not planning, that is guessing. And guessing can become expensive when SARS asks questions. Before we continue, let me pause here. If you are not sure whether you should pay yourself through salary, dividends, reimbursements, or another method, this is exactly the type of issue we help business owners think through. You can schedule a free consultation with us, and we can help you look at your structure, your records, and the cleanest way forward. The goal is to help you stop guessing with money that affects your tax compliance. Now back to the video. Now let's talk about reimbursements. A reimbursement is when you personally paid for a valid business expense and the business pays you back. Maybe you used your personal card for business stationery, business travel, or an urgent company cost. That can be fine, but only if the expense is genuinely for the business and you have proper records. You need slips, invoices, proof of payment, and a clear explanation. Without that, the reimbursement can start looking like another personal withdrawal. Then we have loan repayments. Sometimes the owner has lent money to the company. Maybe you started the business with your own savings or paid business costs from your personal account. In that case, the company may repay the loan to you, but there must be a clear loan account and records showing that the business actually owed you the money. Otherwise, your accountant is left trying to rebuild the story afterwards. Now let's look at the messy version. This is where the owner uses the company account like a personal wallet. School fees, groceries, personal fuel, holiday costs, and random owner transfers all come from the business account. The business may survive like this for a while, but the records become weak, the loan account becomes messy, the true profit becomes unclear. And when SARS, the bank, or even a potential investor looks at the records, the business does not look professionally managed. This is not only a tax issue, it is a business discipline issue. If you do not separate business money from personal money, you may never know whether the business is truly profitable. Maybe it is just funding your lifestyle while quietly running out of cash. So here is the clean system. First, decide the payment method upfront: salary, dividend, reimbursement, loan repayment, or drawings. Second, use clear descriptions when money moves. Third, keep documents such as payslips, dividend resolutions, invoices, slips, loan records, and reimbursement schedules. Fourth, separate personal spending from business spending. The company account is not your personal wallet. And fifth, review this monthly, not only at year end. By year end, you are often cleaning up, and cleanup is always more painful than planning. So the main lesson is this: do not take the money first and explain it later. Decide the tax treatment up front, document it properly, and keep the company account clean. Paying yourself is not the problem. The problem is paying yourself in a way that leaves messy records, weak financial statements, and possible SARS issues. If your company account has become mixed with personal spending, don't ignore it. Book a free consultation with us. We'll help you understand what happened, what needs to be cleaned up, and how to create a better way to pay yourself going forward. Because the goal is not just to take money out of the business. The goal is to take money out cleanly, legally, and in a way your accountant can actually defend. I'll see you on the next video.